There is a lot of confusion around the types of loans that can be used to purchase a home. When we go through your unique situation, we'll discuss what options make the most sense for you, but I wanted to put together an overview of the various products out there. FHA loans are insured by the Federal Housing Administration. They are generally easier to qualify for than conventional loans, as they will allow for a credit score down to 580. The minimum down payment is 3.5%, but it can be combined with FHA's buyer choice to help finance the down payment and even some closing costs. There is an upfront mortgage insurance premium, which can be financed into the loan. There is also monthly mortgage insurance, which will be in place for the life of the loan. Maximum loan amounts are set on a per county basis, and like all government loans, the property will need to meet certain condition requirements. For those who meet the military service requirement, a VA loan is an excellent option. Qualification is generally less stringent, and you can borrow 100% of the purchase price. There is an upfront funding fee unless you are exempt, but it can be financed into the loan. With the VA, there is no monthly mortgage insurance. The loan will also let you use seller credits to pay off existing debt. Again, though this loan will require the property to be in a certain condition for approval. USDA offers Rural Development or RD loans. To qualify, you must be below the income limit for the area, and USDA loans go by household income, not just the parties on the loan. It's also only allowed in certain areas determined as rural. Most of Montana fits this, but there are certain pockets, say outside of Bozeman or in Bozeman, that do not qualify. They will allow 100% financing, and in cases where the property appraises for more than the purchase price, you can also finance some of the closing costs into the loan. They do generally have tighter debt-to-income ratios than FHA or VA. There is also an upfront guarantee fee. This can be financed into the loan, and there's a monthly fee for the life of the loan as well. Once again, though, the property must meet condition requirements. The term conventional loan covers a lot, but the one thing they have in common is they are not government insured, although there is still a good deal of government oversight. The most well-known are conforming loans, which are going to meet the criteria of Fannie Mae or Freddie Mac, which are considered government-sponsored enterprises, or GSEs. There are nuances between Fannie and Freddie's requirements, so it's possible to qualify for one and not the other. In most cases, these loans are going to be best suited for borrowers with higher credit scores, and they have a higher minimum credit score threshold. But you can purchase a home with as little as 3% down if you meet the criteria. There is no upfront funding or guarantee fee, but with less than 20% down, they will require private mortgage insurance. On a primary residence, the mortgage insurance will drop off when the loan hits a certain loan-to-value. If you income qualify, Fannie Mae has their Home Ready program, and Freddie Mac has their Home Possible program. Both can have additional advantages for a buyer. In the conventional world, there are also non-conforming loans, which do not need to adhere to GSE guidelines. An example is jumbo loans, which exceed the conforming loan limit. Non-conforming loans can be used for unique properties that might be exempt from other avenues. They also have alternative documentation options. For instance, self-employed borrowers who don't qualify traditionally may be able to qualify for a bank statement or P&L loan. Within the loan types themselves, there is a subcategory for renovation loans. If you find a property that needs a bit of work, a renovation loan might just be the solution to be able to purchase the property and finance in the cost of the repairs. They can also be a great refinance option if your current home is in need of a facelift. FHA has a 203K loan that has a streamlined version, which will cover up to $35,000 in repairs. This can be a great option for those homes that need some help to be brought up to FHA standards, like new paint, handrails, etc. There's also the standard version for larger repairs. Fannie and Freddie both have renovation options. Those will allow for not only the home changes, but can also finance items like adding an accessory dwelling unit, which could be used for extra income or to house aging parents. Properties that need some TLC are often on the market longer and will usually have more bargaining room. Maybe you love the neighborhood, but the house is outdated. Perhaps it would be great, but you just can't live with that kitchen. Be sure to consider all of your options when shopping. The down payment requirement is the same as the loan program sponsoring it, so you can still get into a home for little down. If you own a lot or found the perfect lot and need to start from scratch, a construction loan will be your option. The requirements can be a bit more stringent for credit score and for down payment. As always, it's important to get pre-qualified. You will need a builder and finalize building plans for a construction loan. Also, if an existing structure needs extensive renovations, a construction loan may be the best fit. Last but certainly not least is CMG's proprietary product. The all-in-one loan is a loan, home equity line of credit, and a checking account combined. It applies payments to loan principal first, which reduces the balance and builds equity quicker and potentially saves thousands in interest. You have 24/7 access to home equity dollars without the need to refinance. This loan isn't the fit for everyone, but it is a game changer for those who are suited. I have tons of resources on this product if you would like to dig deeper or to see if it's a fit for you. I hope this was helpful. Please reach out with questions and please check out my other available resources.